Hi everyone, welcome to our market outlook for the month of August. I'm Vivian and I have here with us our Chief Investment Strategist, Steve Brice. Welcome, Steve.
Thank you.
A month ago, people were becoming concerned about the global economy. Is this still the case?
Well, I think if you look at the data, generally it's still very weak, and in most cases it's still disappointing, whether you're looking at the data out of the US, Europe or China. I think something positive that's come out is that the data is starting to disappoint less, which may sound, sort of a quite benign sort of way of looking at it. But usually these things happen in cycles. So when we start seeing disappointments reduce, and eventually they become positive surprises. So that's sort of the hope over the next 1 to 2 months that we'll start seeing that development. Key though is actually what's going to happen in the US. That's absolutely key. So far we've only seen a stabilisation in that economic surprises index, we call it. And we really need to see that bounce before we see a more proactive or positive environment for equity markets.
Given this backdrop, what are the preferred asset classes for investors?
Well, if we're looking sort of 12 months out, our preferred asset classes are threefold. They're high yield bonds, high dividend yielding equities in particular, global equities at the headline level, but also high dividend equities, and Asian local currency bonds. So in terms of high yield bonds, well, I suppose they all fit into our Be Paid category within our VVIP strategy that we rolled out last month. All three have reasonable yields on them, and that should be positive for investors. So we see that as those as being the main three areas where investors should get some positive and fairly significant returns over the next 12 months.
Expectation of further monetary stimulus is key to stock market performance. What is the likelihood of more easing?
Well, absolutely right. I mean, we've been talking about cheap valuations for 12 to 18 months now, and really what we're trying to find out is what's going to make them less undervalued, i.e. see a very positive market outcome. Two things we're looking at: the US Economic Surprises Index bottoming. That's got a reasonable correlation with equity markets. When that happens, equity markets generally do well. Last year that occurred, albeit with a slight lag. And then the second thing is monetary easing. There's a good correlation again between monetary stimulus coming in and equity market performance. Most people focused on the Fed. To be honest, we actually think the US economy is going to be stronger than many anticipate in the second half of the year, beginning in the third quarter. So that might delay quantitative easing out of the States. So we're very focused on what's going to happen in Europe. Spanish bond yields now well above 7%, 10-year yield above 7%. We believe that is an indicator that something needs to be done, and that needs to happen quite quickly. A lot of people obviously talking about different mechanisms that you can try and intervene in bond markets to push yields down. For us, what is key is that ECB comes in and prints money and directs that money towards the bond market. We should be getting closer to that outcome, and we can talk about days, weeks or months, but we do believe we're getting closer to that outcome, and that should lead to a bottoming of stock markets in the next month or two.
Commodity stocks, particularly mining stocks, continue to reflect pessimism for the sector. What should we make of that?
Yeah, it's very difficult because obviously mining stocks have been a fairly poor performance for some time. Whether you're looking at gold miners, whether you're looking at base metal miners, and also the oil majors as well. So part of it is saying, is this great value or is it a value trap? I suppose as far as gold miners concerned, we've become increasingly concerned about the performance. We tried to rally in May. That rally has faltered. So we've taken a bit of a back step and said, look, we still believe there's huge value there, but we're trying to find a catalyst that's going to generate it. Monetary stimulus could be that catalyst, but really want to see a stronger performance before we sort of push that idea again. In the other commodity space, we do like energy producers, largely because they pay a decent dividend yield, but also we believe oil prices will remain well supported from here. We also like some of the copper producers as well, again cheap valuations, and as China recovers we should see some demand coming through for base metals, which we believe are in the process of bottoming out. So there's value there, but I think you still need to be relatively selective.
What is our outlook for the Aussie dollars and Chinese yuan going forward?
As far as the Aussie dollar is concerned, I suppose it's consistent with the Chinese outlook. A U-shaped recovery coming through in China is what we're expecting. So better data already coming through to some degree in June, but then also that's expected to extend on further easing into the third quarter and fourth quarter. So against that backdrop, as we mentioned, base metals should start doing better, and that should also support the Australian dollar. So there is the risk of a short-term correction on European woes. But over a longer term, we would expect weakness to be a buying opportunity. As far as the Chinese renminbi is concerned, we're actually looking for it to be relatively range-bound going into the rest of the year. China again stimulating policy, clearly a much stronger currency would counter those efforts. So we expect them not to allow it to weaken significantly, but just to remain where it is roughly.
On Singapore property market, do we see any risk of a huge price correction?
I suppose what we were looking at a couple of years ago was talking about property market in real terms being overvalued quite significantly. And so you're talking about potential for a 30% correction in real terms. But what we've seen is over the last 18, 24 months, we've seen inflation take care of around 10% of that. So that's allowed nominal prices actually to stay the same, but real prices have dropped somewhat. And then we're seeing that going forward as well. So current inflation rate at 5.3%. Unlikely to drop dramatically, maybe just below 4% next year. So that's going to lead to some of the price adjustment that's required. Net, we would expect prices to be in the sort of 0 to -10% range over the next couple of years. Key thing to watch out for is additional supply. 2014, we've got increasing supply in the central region of Singapore, and then outside central region in 2015. So that's going to be a key factor that's going to lead to a challenging time for the property market over that period.
Thank you for your time, Steve. We'll see you again next month.
Thank you.